When sorting out your tax affairs, it's crucial that you understand how the government looks at your income. Because in the last topic, we only really discussed income from employment. So let's draw up a holistic example. Let's say that Tom here is 20 years old, he's working full-time with a construction company, and he's earning $40,000 a year. So we're going to say that this $40,000 forms part of what's called his assessable income. This term basically means that this type of income is liable for tax. This is opposed to having something called exempt income. That's right, so the government actually deems that there are some forms of income which you may not have to pay tax on, even if your total income is above the tax-free threshold. Some examples could be certain government welfare, childcare and disability allowances. Other forms could be scholarships, financial gifts from relatives, or small winnings from bets on the horse races. Now remember, these are just examples, so before you assume that a source of particular income is exempt, make sure you thoroughly research this beforehand or consult a registered tax agent. Okay, coming back to the example. Let's now say that Tom has also earned $1,000 in bank interest, and we'll also say that as a side business, he creates podcasts on YouTube, which earns $3,000 in advertising profit for the year. So both these types of income would also be considered as assessable income. An easy way and a rule of thumb to identify whether you generate an assessable source of income is to look at whether the income is earned from personal exertion. In other words, a job. Alternatively, the income could be earned from a financial or property asset in the form of rent, dividends, or bank interest. A third source is income earned from running a business. Remember from the last video that you can operate a business as a sole trader or as an incorporated company, and this will determine the tax rate which you'll pay on this income. And finally, profits generated from the sale of a financial or property asset can also be assessable income. This is sometimes referred to as a capital gain, and as we went through in the investing module, this is the difference in the price which you bought the asset for and sold it for. So if you want to get a little bit technical, the first three forms of income are categorized as ordinary income, and the last form is categorized as statutory income. It's important to know that if you fail to accurately disclose various forms of assessable income to the government, you can face quite harsh legal penalties. This means you should make a point to establish an ongoing record system. What I mean by this is firstly going to your local newsagent, getting a folder and filing away any payslips if you're an employee, invoices if you're a business owner, bank statements to track interest, and relevant documents showing proof of the sale of an asset. This will save you considerable time when it comes to lodging a tax return, and it'll also ensure that you're accurate with your income disclosure. And that covers income. As you can see, the Australian government has thought of ways to tax you beyond what you earn from employment.